Most people enter the world of trading with a very specific, very logical goal. They want to win. They want to win more trades, be right more often, and find that one perfect entry point where the price moves exactly where they predicted. It sounds like common sense. In almost every other area of life, from sports to academics, the person who wins the most is the most successful. If you win 90% of your chess matches, you are a master. If you get 90% of the questions right on an exam, you get an A. Naturally, we assume that if you win 90% of your trades, you must be making a fortune. But here is the mechanical reality that breaks most beginners. Not exactly. In the world of market mechanics, you can be right 90% of the time and still go completely bankrupt. Conversely, you can be wrong 60% of the time, losing more often than you win, and still be incredibly profitable. This is where the logic of the average person fails. Trading isn't a game of being right. It's a game of expectancy. Once you realize that your win rate is only half the equation, your entire perspective on the market shifts. To understand this, let's look at a mechanical comparison between two hypothetical traders. Trader A is a high-accuracy trader. They win 8 out of every 10 trades. On paper, they look like a genius. They are right 80% of the time. Trader B is a low-accuracy trader. They win only 4 out of every 10 trades. They are wrong more than half the time. Who makes more money at the end of the month? Most people would bet their life savings on Trader A. But here is the catch that ruins most retail accounts. Trader A hates being wrong. When a trade goes against them, they hold on to it, hoping it will turn around. They take tiny $100 profits on their 8 wins, but on their 2 losses, they lose $1,000 each because they refuse to cut the cord. At the end of 10 trades, Trader A has made $800 but lost $2,000. They are down $1,200 despite their high win rate. Trader B, however, accepts that they are often wrong. They take small, $100 losses quickly. But when they are right, they let their winners run, making $500 per win. At the end of 10 trades, they've lost $600 but made $2,000. They are up $1,400. The mechanical truth is clear. What matters isn't how often you win. It's the magnitude of your wins versus the severity of your losses. In professional circles, this is known as the risk-to-reward ratio. It is the single most important structural pillar in trading. Imagine a system where you risk $100 to make $300. This is a 1-to-3 ratio. Mechanically, this ratio creates a buffer for failure. If you have a 1-to-3 ratio, you only need to be right 30% of the time to break even. Anything above a 30% win rate is pure profit. But most beginners do the exact opposite. They practice inverse risk to reward. They risk $500 to make a quick $100 profit because a win is a win. This is a mathematical trap. When you risk $5 to make $1, you have to be right nearly 90% of the time just to stay at zero. One single mistake wipes out 9 correct decisions. This is how accounts bleed out slowly over months and then blow up in a single afternoon. You are building a skyscraper on a foundation of toothpicks. So if the math is so simple, why do people stay obsessed with their win rate? Because winning feels like status. Winning triggers dopamine. It feels like progress. It feels like you have conquered the market. Most importantly, nobody likes the feeling of being wrong. In our daily lives, being wrong is associated with failure, embarrassment, or lack of intelligence. Beginners bring this emotional baggage into the market. They try to avoid losses at all costs because a loss feels like a personal defeat. They hold losing trades longer, hoping the market will return to their entry point so they can exit at break even and prove they weren't wrong. But the market doesn't care about your ego. In trading, losses are not failures. They are the cost of doing business. Imagine a restaurant owner trying to avoid buying ingredients because they don't want to spend money. You can't have the revenue without the expense. Trying to avoid losses is what causes the catastrophic account-ending losses. The real goal in trading is not to strike it rich on the next trade. The real goal is survival. The market is a game of probability that only pays out over a long sample size, hundreds of trades. But to reach that 200th trade, you have to survive the first 199. If you lose too much capital too fast, you are out of the game. No capital means no opportunities, and no opportunities means no future. Professional traders have a defensive mindset. They don't look at a chart and ask, "How much can I make?" They ask, "How much can I lose before I'm proven wrong?" This is a complete structural shift in thinking. By focusing on the downside first, you ensure that even a string of 5 or 10 losses in a row, which will happen, doesn't take you out of the game. Protecting your capital is what allows your edge the time it needs to work. You aren't playing to win, you're playing to stay at the table. Let's look at the mechanical difference between losses. A small loss is manageable. It's a paper cut. You lose 1% of your account, you still have 99% left. You can recover from that in a single good trade. You can continue trading with a clear head and a stable strategy. A big loss is structural damage. If you lose 30% or 50% of your account on one hope-filled trade, the math to get back to zero becomes an uphill battle. To recover a 50% loss, you need a 100% gain. That desperation leads to even more risk, higher emotions, and eventual total failure. Experienced traders are professional losers. They accept being wrong quickly and dispassionately. They use a stop loss, a hard mechanical limit that exits the trade automatically when the thesis is dead. They know they don't need to be right every time. They just need to stay small when they are wrong. This leads us to the final mindset shift. Trading is not about perfection. The holy grail of a 100% win rate doesn't exist. You don't need the perfect entry at the absolute bottom. You don't need to predict the news. You need consistency. A simple system with a positive expectancy, repeated over and over again with controlled risk, will grow an account over time. But inconsistency is the great destroyer of wealth. One emotional trade where you double down to prove a point. One trade where you forget your stop loss. One YOLO trade with too much size. These are the moments where months of disciplined work are undone in minutes. The market doesn't reward the smartest person. It rewards the person who can follow a boring mechanical process without letting their ego interfere. So what is the real game of trading? It is the management of uncertainty. It's about controlling your losses so they remain irrelevant. It's about having the discipline to let your winners grow, even when you're tempted to take the money and run. It's about staying disciplined when you're on a losing streak and staying humble when you're on a winning streak. In this system, winning trades are just data points. They are a part of the process, but they are not the goal. Because in the cold reality of the market, you don't get paid for being right. You get paid for managing risk correctly. You get paid for being the person who didn't blow up when everyone else did. Most traders focus on winning, and that is precisely why they struggle. They are chasing a feeling instead of a formula. Trading isn't about winning more trades. It's about losing correctly. It's about building a mechanical structure where your losers are small, your winners are large, and your discipline is unbreakable. Once you stop trying to win and start trying to manage, your entire relationship with money and markets will change. If you want to keep understanding how trading, wealth, and these complex systems actually work, simply, clearly, and structurally, subscribe. Let's keep fixing the mechanics together.